In New York City, I'm Shauna Smith alongside Brad Smith. This is Yahoo Finance's flagship show, The Morning Brief, the ultimate guide to help investors make smarter decisions for their portfolios. We're tracking early session volume while bringing you today's top market themes and elevating Yahoo Finance's most popular newsletter.
That's right. We've got a huge show for you on this Thursday morning, this Friday's Eve. As futures right now, we're tracking the Dow, the S&P 500, and the Nasdaq. They are mixed after the S&P 500 and the Dow closed at record highs on Wednesday. S&P 500 nearing 5,000 for the first time ever.
That would be quite the milestone. Well, earnings are really driving the early action. Reports from Disney, ARM, and PayPal setting the tone ahead of the bell this morning. So let's get right to it. The three things that you need to know. Your roadmap for the trading day. Yahoo Finance's Josh Schaefer, Alexandra Canal, and Madison Mills have more.
Hey, Shauna, stock futures are edging slightly lower this morning, but that's coming on the heels of a record close for the S&P 500 and the Dow. The S&P 500 nearing 5,000 for the first time ever. Tech giants Nvidia, Microsoft, and Meta all leading this rally, pushing the Nasdaq Composite up nearly 1% on Wednesday.
And a big day for Disney investors. Shares in the media giant extending gains in pre-market trading on the heels of its quarterly results. The company offering an upbeat profit outlook and boosting its cash dividend by 50%, all while streaming losses continue to narrow. Disney also betting big on games. The company plans to invest $1.5 billion in Fortnite maker Epic Games, but the entertainment behemoth is still grappling with some challenges, including a declining linear TV division, slower growth in its park business, and an activist investor battle with Nelson Peltz, who renewed his push to shake up the company's board late last year.
And shares of chipmaker ARM surging in the pre-market, up 28% after beating on earnings and updating their forward guidance. And this is really about two things. One, continued demand for its chips in the mobile phone market, and excitement over revenue to come for its AI devices.
All right, well, top of the 9 a.m. to you. Let's get to our top story. Markets rallying 30 minutes ahead of the opening bell just about. And we're seeing stock futures right now. They were mixed here. We're keeping close tabs on the Dow, the S&P 500, and the Nasdaq. The S&P and the Nasdaq futures look like they're both pointing lower as of right now here. We're going to watch that closely here. 5,000 level for the S&P 500. That's in watch. The question becomes, can the rally be sustained? Joining us at the desk, we've got Yahoo Finance's Josh Schaefer. Hey, Josh.
Yeah, Brad. I mean, can the rally be sustained? Feels like the question we've been asking for around a month now.
Far too long.
Yeah, and we've been able to hang out around there, right? As far as what's been driving the market this week and sort of what I'm thinking about and why I don't think the narrative has really changed. You guys have been talking a lot about Fed speak this week. We've heard from different Fed officials. I don't really think we've heard any difference in narrative there. And so I think that's your first check mark, right? Are we still sort of talking about the same things we were talking about last week post FOMC? I would say yes. And then when we take a look at earnings, are we still talking about a similar earnings story? Have we had a big shoe drop that has people overly concerned? I would argue no. So you take a look at what we're looking at there, that's consensus expectations. You see right now FactSet for Q4 2023, 1.9% is what they're seeing for earnings. That number was actually negative 2 weeks ago. Big tech helped take us higher there. And then you had some beats from companies like Disney last night that probably might push that number even higher. So I think when you think about earnings, that story hasn't really changed either. So largely, guys, we get to the only reason to sell stocks right now. The main reason would be, well, they're too expensive and only 4 or 5 of them are driving the S&P higher, so we have to go down at some point.
Yeah, and Josh, what's the thinking out there on the street? Because we have talked almost ad nauseum about this, right? How concerned should we be that it's just a handful of stocks that have really been driving the market's momentum? That is nothing new. That's been the case now going back at least over a year. So in terms of that risk, I guess put that in perspective for us, because there are a number of strategists who have been bullish for quite some time, and they've remained bullish, and they're not really shaken at all by the risk that could potentially pose.
One of those bulls, we love his charts, Brian Belsky, right? He was out addressing this specifically in a strategy note earlier this week. And one thing that Brian pointed out was when we get to this sort of quote-unquote overextended part of the market where 10 stocks are leading, when that leadership falls off, we've actually seen stocks rise. So that chart you're looking at here, that's an average of 14.5% for the S&P 500 in the year after the top 10 stocks stop leading the stock market. So if we were to see the top 10 stocks right now take a step back, the average return is about 14.5%, which of course is quite good. The other thing though that I would say, even Belsky is pointing out and several other bulls in the street have been highlighting, no one expects the line for the S&P 500 to be linear this year.
Yeah.
And when we think about potential for a pullback, basically every bullish strategist right now on Wall Street is saying, well, at some point we're going to get a pullback. You always get a pullback. At some point we're going to get a pullback. So no one is saying it's fine that 4 stocks are leading. It's always going to be 4 stocks. I think what a lot of people think we're going to see is maybe a pullback. Then once we get a little bit more certainty in the Fed, that's your breath rally. Once we understand where rates are going to go, then the take is that's when your Russell 2000 small caps come into play, your interest rate sensitive sectors come into play in the second half of the year. And that's sort of the case for right now. I mean, the highest target we track on the street is only 5,200. That's pretty close to 5,000. So we're not talking about that much more.
Upside, yeah, between now and year's end. Although, if history were to repeat itself, last year we saw strategists a number of times raise their targets as we neared the end of the year. So we'll see how this all shakes out. All right, Josh, thanks. Let's get to one of our big movers of the day, and that is Disney. Shares extending gains after beating on first quarter results and boosting their forward guidance. Now, the company also announcing a new partnership with Epic Games. You're looking at a move, look at that, at just about 8% ahead of the open. Now, it did impress the street, but Nelson Peltz, activist investor, he's still not buying it. Spokesperson for his Triumph Fund is saying that, quote, it's deja vu all over again. We saw this movie last year, and we didn't like the ending. For more on this, we want to bring in Brandon Nespel. He is a KeyBank Capital Markets research analyst. We also have Yi Tai, Santa Clara University Associate Professor of Finance. Great to have both of you here. Let's talk about what we heard last night, Brandon, because there was certainly a lot to be encouraged about. When you take a look at the streaming business, clearly in a much better spot, to put it lightly, than where we were a year ago. The parks business was also one of the standouts here. A lot of things to be excited about in terms of the restructuring or redirection of Disney's business. Is it enough, though, to prove that outside influence or an outside factor maybe isn't needed at Disney?
Well, I don't think there needs to be outside influence. I think Bob Iger seems to have everything under control. And the main areas of improvement were really around cutting content expense. You know, our concern is for a content company, it's difficult for us to see that content expense can trend lower for forever. And so it's sort of a near-term benefit, if you will, sort of right-sizing the amount of content the company is spending, which has really helped improve profitability across the segments.
Would love to know from your perspective here, as we're thinking about all of what Disney had to say last night and whether or not this quells some of the question marks that many of the activist campaigns had to this point. What is your anticipation of what the rebuttal will be and the campaign will continue to sound like?
Yes, so the activist, the Nelson Peltz, his campaign, one of the attacking point is about Disney's corporate governance. And if we look at the book, all the directors except the CEO, Bob Iger, everyone else look very independent in the sense that they do not have a material relationship with the company. And in fact, all the independent directors adding together, they own less than 15%, less than $15 million in terms of the holding in the company. However, if we look closer, only 2 of those independent directors were appointed not during the CEO tenure. Basically, either some of them are appointed during the first tenure of Bob Iger as CEO or during his second tenure. So inevitably, Bob can have a strong impact on the board. And research called those independent boards on the book, but appointed by CEOs as co-opted boards. And we have found that on average, those co-opted boards tend to weaken the board monitoring and tend to grant higher CEO compensation. And they're less likely to fire the CEO if the company is not doing well. So, and these are the main attacking points of the Nelson's campaign. And as we can see, definitely there are issues potentially with the corporate governance remaining on the Disney's board. Having said that, doesn't mean friendly board can always be a negative thing. If the CEO is really capable of pushing things forward, then those friendly boards can really be providing helping hands there to move CEOs' progress and help improve the firm performance.
Brandon, there's lots of questions, or one of the big pushes here from Peltz. Obviously, he wants Disney to lower and really obviously turn around the streaming part of the business and turn it around, meaning wants it to be obviously profitable and then the growth potential from there. When it comes to what we heard last night over the last 48 hours with the plans here for the new sports app, how much does that then change the conversation, and how much of an impact or how big of an impact do you see this potentially being on Disney's bottom line going forward?
Well, I think in regards to the direct-to-consumer business, the non-sports business in particular, Peltz got probably everything he wanted. Disney, for the first time ever, talked about getting to a double-digit sustainable margin. I think the question will be, how long will it take Disney to get there?
Brandon, what do you think that timeline looks like?
From our perspective, it's more of a 2027 type of timeline, so still a couple of years out. But that's exactly what the Bulls wanted to hear, is some sort of commentary around long-term margin trajectory of the business, is something to anchor the models around once Disney gets to break even later this year.
We do know that Nelson Peltz and his constituents, the people that he's representing, they want to see Disney achieve Netflix-like margins. Do you believe they could do that in kind of congruence with what Brandon was just saying?
So yeah, I have a similar sentiment. It's not an easy battle in the short term. And Disney have shown really nice earnings this past quarter. And they have also do all other kinds of things to really please the investor. For example, they just announced to increase their dividend from 30 cents to 45 cents. So that's their planned dividend payout. However, do keep in mind that before the pandemic, their dividend was 88 cents per share right before the pandemic. So they had to cut the dividend to sustain their cash flow stream. And I'm glad to see that Disney is reinitiating dividend. And that is usually a welcoming sign to the market. But I think being able to really growing their streaming business to a pace that like Netflix, it might take some time.
Brandon Nisbell, KeyBank Capital Markets Research Analyst, as well as Yitai Santa Clara University Associate Professor of Finance. Thank you so much for taking the time here today to discuss all things ticker symbol DIS this morning. Appreciate it. Well, switching gears here and actually staying with Disney for a hot second, one of the biggest announcements to come out of Disney's first quarter report was the $1.5 billion investment the entertainment giant is making in Fortnite's developer, Epic Games. Of course, gamers will be able to use content and characters in Fortnite from Pixar, Marvel, Star Wars, Avatar, and other Disney properties. But what else could this mean for the future of Disney in the gaming space? We've got Yahoo Finance reporters Alexandra Canal and Dan Halley here with us. I saw both of them kind of pumping their fists a little bit as we were even talking about this. So, Ali, just tee this up for us. I mean, the significance of this investment into Epic Games for Disney.
Look, this was a surprising announcement, but it's one that I think analysts and investors are ultimately positive on in the long term. I mean, Disney has amazing IP. That's one of the most valuable aspects of the company. So why not put that in a video game? And Disney has explored video games in the past. They used to have their own in-house studio that shut down in 2016 before they switched to a licensing model. But this stake in Epic Games shows that they're serious when it comes to diving into the gaming business. Why? One, the competition's doing it. I mean, Netflix has really doubled down on games recently, and analysts have said that's an untapped area for Netflix, and obviously an untapped area for Disney. Also, I think this is a way for Disney to really safeguard its business. The media landscape as a whole has been very challenged. You can even look at linear networks. That fell 12% year over year for Disney. This is another way for them to protect themselves as advertising has struggled, as there's secular challenges in the industry. So ultimately, I think this is a good move in the long term. I think it feels a little random if you don't know the intricacies of this space. But again, with the Disney's IP, I think it could be something really significant down the line.
Just on a demographic level, right? When we talk about the fact that how younger generations are consuming media here, Dan, Gen Z, it's a smart play when it comes to that and really getting more Gen Zers under their umbrella.
Yeah, I mean, look, Disney is a game out now called Disney Dreamlight Valley, and it's essentially kind of sort of the same thing where you can build a character and then you can meet all the different Disney avatars, I guess. Jack Skellington, I guess, is one of them. Looking at the site right now, and you can go from like different world to different world in Disney. So you can go to his world and then the Beauty and the Beast world and things like that. So that's kind of the concept that they're going for with that. With this, the epic side of things. This is kind of it's almost a dead phrase now, but it's kind of the metaverse, right? The idea, and this is the metaverse that makes sense, not the strap-on goggles and Ready Player One that Meta wants to do. This is where you would be able to go through different Disney worlds, Disney properties. You can see here Marvel, Star Wars, Avatar is one of them, Pixar. I don't really want to hang out in the Avatar world. It's Fern Gully, all right? And so it's it's something that I think is interesting and that will pay off. It's also important to point out that Epic has gotten investment out the wazoo, right? I mean, from seemingly everyone, Sony, Disney, Tencent. I mean, people pump money into this company, and it's not just Fortnite. It's also the Unreal Engine that powers a lot of video games out there. And so that's something that I think is important to look at as well. But to me, this is really I hate the phrase, but a metaverse play.
And Dan, to that point, the one thing I thought of immediately after this announcement, we know Bob Iger has a good relationship with Tim Cook. Could this be an Apple Vision Pro play down the line? I think that's maybe a possibility. So, that's the thing. It creates opportunities for this company that might not have been there otherwise.
Yeah. Certainly does. And we've seen that relationship on full display. What was it, the last Worldwide Developers Conference when Iger took the stage?
He had the Vision Pro right on there.
Well, you see, yeah, that's a good call there, Allie. All right, Allie and Dan, thanks so much for breaking that down for us here. Let's get to another top trender here this morning, and that is ARM Holdings soaring here in pre-market trading. Strong results from the company. You're looking at a gain of nearly 30% if this move to the upside holds at the opening bell. We bring this up because this really points to the frenzy that we have seen surrounding AI, and strong results like this really point to the fact that, hey, maybe that frenzy, maybe that excitement is far from over. And taking a look at these results right now, when it comes to ARM at least, customers designing new AI chips, higher royalties for ARM, that is how they are winning within this space. But also just digging into these numbers just a little bit and taking a look at the revenue streams right now. They have moved, we know, the CEO there moving to further diversify their business here. And those moves seem to be paying off, Brad, because the smartphone industry accounting for just a third of sales, which is significant for a company like ARM.
4 areas that this company really pointed out that growth is going to be driven by. Number 1, royalty revenue. We talked about that leading up to the first trade that this company had when it was having its initial public offering, and how they changed that entire revenue generation model as well. And so essentially they expect the demand for compute to continue to grow as the complexity and performance requirements of electronic devices, yes, those devices that we carry around or that we have on top of our desks every day, as that continues to increase. Additionally here, growth going to be driven by more energy efficient compute and AI capability. I won't have people's eyes gloss over here, but what you're essentially looking at is the demand for LLMs, large language models. And then additionally here, which was really interesting to me, the ecosystem of software and design partners. They need more of those design partners to really leverage the capabilities that ARM already has, and then look at the number of different devices that those chips can then go into so that it can generate, going back to point number 1, more revenue on a percentage share basis. And then lastly here, just talking about some of the figures that they had mentioned within this report during the quarter, actually Microsoft announcing their first cloud server chip, Cobalt 100. They're also looking at some of the efforts that they're putting forward in cost savings, looking for about $20 million in reduction in cost savings for some customers and themselves. So all of these things considered, I think those are some of the key areas that we can continue to grade ARM on as we move forward from here. But this, of course, in the short lifespan, or the early lifespan, I should say, that this company has been publicly traded, some of the markers that we can hold them to over an extended period of time. Yeah,
and you're saying it's still early days here of this company as a public company. When we take a look at that max chart that we have, this company went public, end of September, beginning of October, in the end of the third, beginning of the fourth quarter of last year. And take a look at where shares are trading today versus where they IPO'd at. If these gains were to hold, we would be opening right around $100 a share, which is almost double from that IPO price. So really pointing to the fact that there is a heck of a lot of excitement surrounding this name.
I don't print out a lot of investor relations and quarterly print offs. I print out rundowns.
This one was worth it.
This one was worth it. It was also pretty colorful on the front, so I had to go ahead
Yeah, that's always visually appealing.
Yeah,
Always
yeah.
trying to strive
Like
for that
those.
at Yahoo Finance. All right, keep it right here because there is much more ahead. PayPal sinking after giving a weaker than expected forecast. Why this matters for your portfolio next. Let's take a look at shares of PayPal. It's our stock to watch here this morning. Shares off just about 8% in pre-market trading after the company issued weaker than expected full year guidance. Now, despite a 9% jump in revenue from a year ago, clearly not enough for the street. Also push here for some cost cutting measures. Madison Mills standing by on the floor at the New York Stock Exchange with more on that. Maddie.
Yeah, it's interesting, Shauna. This is just the latest name this earnings cycle that has had a beat in several areas, right? We had a beat on net income, on payment volume, and on revenue, but it's all about that forward guidance, and those beats just weren't enough to lift PayPal following that earnings print, and that's why we're seeing such downward movement on this name in the pre-market trading. I was taking a look. It's trading far below the 52-week average if you look at the Yahoo Finance platform on PayPal, and it's also looking like on my end, it's down about 9 percentage points, 9% rather, ahead of the market open. We'll see what happens when we hit that opening bell. But this is really interesting to me because it continues to be about this pressure for constant forward growth for these companies, and that's difficult for PayPal, even though they do have the merchants on their side, right? They've got about 30 million merchant partners that love PayPal. This allows us, when we're online shopping, to check out really easily. But the competition really comes in with the likes of Apple Pay. When you are, getting into the subway in the morning, for example, you're using Apple Pay, you're not necessarily using your PayPal app, and that competition is what's weighing and putting pressure on those profit volumes. That's one of the potential reasons why we've seen PayPal cutting costs, cutting about 9% of their workforce to the tune of 2,500 workers as of last week. Will those cost-cutting measures be enough for them to maintain a strong balance sheet moving forward? That's going to be the big question for them throughout 2024.
All right, Maddie, it will be. And we're going to be talking with an analyst later on in the hour, getting his insight on the latest results that we're getting here from PayPal. Maddie, thanks. All right, let's take a look at some of our other trending tickers. Tapestry shares getting a boost in pre-market trading. The company beating expectations off the back of strong sales from its Coach brand. Now, Tapestry also raising its full-year profit outlook. We're looking at a gain of nearly 4%. But Brad, I was reacting to this almost in real time here, talking about it's amazing to see the turnaround that's taking place, especially under their Coach brand. The strength that we are starting to see in sales, it's once again resonating with a younger audience, something that we have not seen in years. Coach sales were up about 6.4%, over $1.5 billion. They also saw some bright spots in the recovery in China, growing in the mid-teens, and that was enough to offset weakness in Kate Spade and weakness in Stuart Weitzman.
You want to win an earnings report release? Add J-Lo to it. That's exactly what Tapestry did for all the folks out there who haven't checked this one out. We checked it out for you here. Record second quarter revenue, the company talking about, and they also raised that outlook as you were bringing up a moment ago. One of the huge things to continue to look across, though, is the regions here. International revenue growth, 12%, but gains across key regions they talked about, 19% in Greater China. You pair that with some of the other spending data we see coming out of the region, people are buying bags and shoes, apparently. Also in Japan, you saw growth there of 6% and then 9% in some of the other Asia is how they kind of rounded out, and then 11% in Europe as well here. So, of course, a lot of focus on how they're performing in different markets. Also, the omni-channel experiences, D2C revenue increased by about 4%.
Yeah, certainly a lot to like in that report. All right, let's also talk about Hershey because shares on the move in pre-market trading. They raised their quarterly dividend by 15%, but look at that, the stock's still under pressure, off just about 2%. A lot of that is because of guidance and the fact that higher cocoa prices, the company warning that it's going to limit earnings growth this year. And digging into this report just a bit, their North American snack business, salty snack business, also taking a bit of a hit here in the most recent quarter, off 25% on a year-over-year basis for their sales. Last time we talked about Hershey, it's a similar narrative this time around, and there is some concern about the popularity of weight loss drugs, the GLP-1s, and exactly what it does to some of these consumer-facing companies, consumer staples, or I don't know if you'll categorize chocolate as maybe more of a discretionary purchase, but clearly it gets hit, and a lot of times that people do cut back on their spending, and they are shifting their buying habits. A name like Hershey's could get hit.
We'll call it pantry discretionary. How about that? You know, at the end of the day, too, it sounds like there's going to be some cost savings initiatives that they have to implement that could impact headcount as well. So once again, a restructuring consideration there. A company where they power the park where I did my senior year trip in Pennsylvania growing up.
Wow, that's a
physics
good
trip.
Field trip.
Best one.
Ours is
At
Six
least
Flags.
the best one I can remember. What?
Yeah.
I got gypped. Guys, coming up, we've got the opening bell on Wall Street, the other side of the break.
All right, just about 30 seconds here until the opening bell. And Brad, a lot of the focus is going to be on the S&P coming off another record close. And it's all about that 5,000 level now, whether or not we're going to cross that milestone.
Absolutely. Maybe today's the day. Maybe this is it. A lot of bullish calls out there would hope so.
And there is the opening bell on Wall Street. Some excitement here from the Nasdaq and from the New York Stock Exchange. New York Stock Exchange up on your screen there. Best friends ringing the opening bell, and then look at that excitement playing out from the Nasdaq. Again, we're coming off a record-setting day for the markets with the S&P and the Dow notching record closes. Big question whether or not that momentum can continue. Madison Mills is at the New York Stock Exchange with the latest on that for us. Maddie.
Yeah, guys, I'm just taking a look at what we're seeing in the opening bell. It's going to take a second for my futures to adjust here. Looking like we are not hitting that 5,000 mark just yet on the S&P, but maybe we'll be able to break some news with our guest. Here I've got Michael Reinking. He is the senior market strategist here at IXIC. Michael, thanks for making time for us again here. We've been talking about how it's been kind of a meh week on the street, but what's going to be driving the market moves today?
Yeah, so thanks again for having me back on. Yeah, as you pointed out, we're kind of in a little bit of a void of economic data after the labor market data last week. We got the Fed speaking last week, and basically officials have kind of parroted that message throughout this week. So markets have gotten a little bit desensitized to that. This morning we got initial claims and continuing claims data, basically in line with expectations. We've seen that trending a little bit higher over the last few weeks, and given the amount of layoff announcements we've seen recently, we'd expect that to continue to move a bit higher. But it's a little bit of a quiet week. We do have potentially a big piece of economic data tomorrow as we have revisions to CPI, and then next week we look forward to retail sales and the inflation data.
Let me ask you about the layoffs question, because I'm curious whether that's indicative of a sickness within the labor market, or is it about cost cutting, everyone following Meta's year of efficiency that worked out so well for them?
Yeah. So, I think it's a little bit of both, right? And you would expect to kind of see that. I don't think we're really seeing kind of numbers that are alarming in terms of the labor market, right? If you look at the labor market data we got on Friday, we had a very strong non-farm payrolls number, though there is some skepticism in terms of the kind of seasonality and some of the adjustments that we might see as we turn the year. But I think, what you just highlighted has really been kind of one of the keys, one of the key themes that we've seen kind of within earnings season this year, right? And that, companies are really kind of focusing on efficiency, right? Kind of doing some cost cutting. That way, if we do start to see a little bit of a slowdown, kind of within the economy, right, they're able to kind of offset that, right? And then there is the potential, some that builds in some operating leverage, right? If the economy does start to, something that we'd seen, kind of Meta's kind of 2 years ahead of the pack, on that front.
Another theme has been dividends. To what extent do you think the street is really excited about any company that's announcing more dividends to come this year?
Right. I think in terms of dividends, right, that is like a sign of that companies are comfortable, kind of with their earnings trajectory going forward, right. So it is a sign of confidence, kind of in the business model, right. We are starting to see, some of the capital return programs start to focus on dividends a little bit away, from some of the share buybacks that we've seen. Just this morning, our parent company here, Intercontinental Exchange announced a 7%, increase to our dividend, right. So that is something that we're seeing. And I think we'll continue to kind of see that, as we go forward.
And as we go forward, I'm fascinated by this idea that the S&P is priced at 20 times earnings, but we're also expecting so many rate cuts. Those two things just don't quite add up to me. Where do you see a catalyst coming for more growth moving forward?
Right. So, I think we just kind of touched on that a little bit, right? So the two themes, within earnings season, we just talked about kind of cost cutting. And then the other side is just kind of the strength in kind of earning and, technology earnings, right? And the growth rates that we've seen, in that industry, right? So that's kind of the bifurcation, that we've seen kind of within equity market performance, right? In terms of, those tech stocks really leading. That's also kind of skewing, kind of the valuation metrics, right? As those companies which are having, really significant growth rates on a go-forward basis, right, are trading at much higher multiples. Now, this, the thing that drives that growth, we just kind of talked about in terms of kind of that cost cutting, right, and that operating leverage that companies will have, as they sort of, kind of draw some costs out of the business. And when we do see the business cycle start to improve, right, that earnings trajectory can really pick up.
Right, continuing to cost cut moving forward and hoping for continued demand as well. Michael, thank you so much for your time. We really appreciate it. I don't think we've hit the record, guys. I'm going to let you guys check because you've got the numbers in front of you here. So back to you, Brad and Shauna, to hopefully break that news at some point today.
Yeah, hopefully. It's a note for right now, though. Thanks so much for joining us, Maddie. We appreciate it. Plus, Michael Reinking, who is the NYSE Senior Market Strategist. And continuing on with this conversation, as we're continuing to be on 5,000 watch, we'll step away from that for a hot second and go back to New York Community Bank Corp. As we've been tracking that throughout this week, it's on shaky ground as it attempts to reassure investors of its deposits, liquidity, and governance. Now, this comes after the regional bank suffered a week-long plunge in its stock, plus a credit downgrade from Moody's. The turmoil stoking concerns about the industry's vulnerability to commercial real estate troubles. Here to discuss where this leaves the banking sector at large, we've got Sheila Bair, who is the former chair of the FDIC and author of children financial literacy books, Daisy Bubble and Money Wizards. Ooh, personal favorite there. Sheila, thanks so much for taking the time here on the day. First and foremost, I think a lot of people who have been tracking shares of NYCB are just wondering, is this a canary in the coal mine or something larger for the CRE market?
Yeah, so we've known commercial real estate was going to be a problem, is a problem, and it's going to be a worsening problem. So yeah, it's going to, a lot of banks are going to, that have heavy exposures to certain categories of commercial real estate. It's important to understand that's a big group. We're really talking about urban office, some urban retail, and some multifamily. Most multifamily housing, which is included in the commercial real estate definition, is actually, that's a good place to be. But in certain pockets, and particularly New York, where you have some pretty restrictive rent control laws, you're seeing some distress. So I think it's important to not, taint the entire sector, but yet within those segments, CRE is a problem. And many of these regional banks do have a heavy exposure to the distressed parts of the market, and they're going to need to work through that. Hopefully they've reserved enough, but we'll see. If they don't, we're going to have probably a few more bank failures, but it's nothing like what we saw during 2008.
Well, Sheila, if we were to have a few more bank failures, like you're saying, as a potential risk at this point, what does that fallout look like, and the risk that could then pose maybe to some of the other banks that aren't on as firm a footing here financially?
Yeah. Well, we saw, runs on uninsured deposits after we had the 3 failures last spring, even with this so-called systemic risk determination and the government saying they were going to protect uninsured, you still saw a run. So that instability in uninsured deposits is still there. There is less reliance now among these mid-sized banks on uninsured, but it's still significant. And I don't, for the life of me, understand why the Biden administration has not asked Congress to reinstate the FDIC's authority to provide temporary emergency expanded deposit guarantees, at least for business transaction accounts. So we're kind of in the same place we were last spring and still at the same risk of uninsured deposit runs. So I think that's something regulators need to deal with and go to Congress and get reinstatement of the FDIC's emergency authority. They're trying to cover this through lending facilities at the Fed and the Federal Home Loan Banks, but that only works until it doesn't. That's much more expensive sources of funding. And it's not, if you're an uninsured depositor, I don't know if you're going to wait around and think, okay, they can borrow plenty from the Fed. If you think the bank's in trouble, you're going to be worried. So I do think this is still a problem, and the Biden administration should ask Congress to reinstate what's called TAG, Transaction Account Guarantee Authority, at the FDIC.
And so if they were to reinstate TAG, would that be a temporary or more long-term?
No, it would be temporary. We used it during the great financial crisis. It was very successful. Put it on, things calmed down, took it off. It's not permanent. I mean, there is another discussion going on about whether there need to be more permanent expansions of the FDIC guarantee. Those can be debated another time. But right now, I think the FDIC does need that emergency authority. Mr. Trump reinstated it, got Congress to reinstate it during the pandemic. I don't know why we can't do that again, but you'll have to ask the Biden administration about that.
Sheila, let's talk about what could potentially happen if that were not to be reinstated, if we were to see a little bit more turbulence within the sector, consolidation. If we don't see bank failure, then of course we could see maybe consolidation. Who would that be among? Would it most likely be among the smaller players, or do you think some of the larger banks would in any scenario get involved again?
Yeah. Well, I think the regulators will be very, very reluctant to sell another failed bank to one of the so-called too big to fail banks. There was a lot of criticism and scrutiny, continuing scrutiny over JP Morgan Chase's acquisition of First Republic. So I think they're going to try to avoid that at all costs. Most of the regionals are healthy. They're fine. Okay. This is not, there are some with concentrated exposures. People kind of know who they are and are watching them. But I think there is room to consolidate among other regionals. And certainly the smaller banks. The community banks really have much less exposure here. They're not really in the urban areas where you're seeing the distress. So that's probably, I don't know to what extent you're going to see any significant community bank failures, but certainly regionals could pick some of those up too, or they could combine. That's what we did during the great financial crisis. The vast majority of community banks that failed, we sold to other community banks. And I think that's the best way to do it.
All right, Sheila, we appreciate the time here on The Morning, breaking all of this down. Thanks so much. Good to see you too.
You bet. Bye-bye.
All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. Bitcoin price is nearing 45,000. It's there right now. Take a look at it on your screen. And Bitcoin miners, Marathon and Riot, they're also surging. For more on this, we've got Yahoo Finance reporter Jared Blickery. Jared, I mean, the excitement is palpable right now, right?
You bet, because remember we were saying, all right, sell the news event. That's what's going to happen on this ETF date when the spot Bitcoin ETFs are finally launched. And that's exactly what happened. And now we're finally back up to those prices. So this is a 3-month chart. And let me just show you this right here. This peak was the top that coincided with the Bitcoin ETF coming to market, the spot ones. But you can see we have traced out this sideways trading range here. We have come above it. One time we've come below it, and this is typical for Bitcoin. We have false breakouts to the upside and the downside all the time, and now we are right back up at the Rubicon 45,000, which I think is a more important price level than this high right here, which is around 49,000, because I think it's an easy bet that if we get above 45,000 and can use that as support, then we're going to see a much higher target, and we'll have to see exactly how that evolves. But we've got all the way up, we got price memory between 45,000 all the way up into the 60,000s with a lot of memory there, or a lot of volume there. So that's what I'm going to be tracking. But as you mentioned, we're also seeing crypto stocks on the move today, and quite a few of them. Marathon up 6.5%. But looking at this board here, back down 35%. PayPal, that's an earnings story as well. That's down 9%. But let me show you the year to date, because a lot of these names still, in fact, all of these names still in the red. Galaxy, the best off, that's still down 2%. Take a look at crypto year to date, and we are just barely in the green. But another thing I point out is that it's mainly a Bitcoin story. We got Chainlink up about 19%, but for the most part, outside of crypto, inside of crypto, when you have Bitcoin and Ethereum and a couple others, the rest is in the red for the year.
All right, Jared, we're going to continue to keep close tabs on this, as we know you will as well. Thanks so much, Jared Blickery. Well, switching gears here, Spirit Airlines posting a narrower loss in the fourth quarter and saying it's assessing options to address its 2025 and 2026 debt maturities. The company's CEO saying Spirit is clear and focused on driving the company back towards profitability in 2024. Our next guest, though, warns Spirit's next problem may be the ultra-low-cost model itself. Mike Boyd, Boyd Group International President, joins us now. Mike, always a pleasure to get some of your insights, especially on all things the aerospace here. First and foremost, you take a look at these earnings, you hear what the company is saying about its pathway to profitability. What type of timeline are we talking about for that profitability?
We're probably talking a year or so. The real issue is, of course, Ted Christie, the CEO, knows what he's doing, one of the best people in the industry. So the airline is in good hands. The question is, will the market hold up? Keep in mind, we are looking at inflation. It's out there, and inflation does affect the number of people that want to go down to Disneyland and ride Dumbo or whatever they do down there. So these discretionary kinds of travel are going to be affected. They're going to have to adjust for that. And again, the costs aren't going in the right direction.
Mike, you talk about the fact that the costs aren't going in the right direction. What about just Spirit's ability to compete? They're saying that they are going to be able to survive if they are a standalone company, but there's a difference between surviving and then succeeding here. What does that competition landscape look like?
Well, the first issue is surviving. Take a look at that entire ultra low-cost sector. And the ultra is pretty much gone in all those airlines. The real issue is what kind of traffic base is going to be out there for them as more and more discretionary income starts to wane a little bit, or even just plumbing. You drive the well is going dry. The number of people that want to make an impulse trip to Las Vegas. You already see Frontier cutting way back on Las Vegas, way back on Florida. I think that's a harbinger of things to come. They're going to have find other types of revenue out there over the next year. And it's going to be really hard. Like Frontier wants to compete with American Airlines out of Charlotte. Good luck, guys. I don't know if there's enough traffic there at whatever fare. So they're going to have to dance around. But the good news, again, is Spirit's aware of this, and they've got a management team that can pull it off.
And so with that in mind, we've also got the acknowledgement of the fact that they have still waited to see, and of course now it looks like all eyes are going to be pointing towards June with regard to JetBlue Spirit and the appellate process that they're trying to have expedited there. We've talked about those expectations in the past, but if this deal does not go through now, how does Spirit need to adjust what even its timeline toward profitability, towards the customer environment, what that looks like?
I think internally, probably Spirit is banking or planning on, not banking on, but certainly planning on another negative result or negative ruling in June. I think that's just going through the motions right now, and they have to go through the motions because it's good for the consumer, it's good for Spirit, it's good for JetBlue. The DOT just doesn't understand that. But the fact of the matter is, I think they're well aware that they're going to have to be going forward by themselves. And I think when you look at their fleet, the airplanes on order, things happening in the airframe business, where suddenly we might have Airbus needing a few extra airplanes for United Airlines and knocking on Spirit's door and saying, "Those airplanes you have on order, can we have them?" So there are some options out there for Spirit. They've got some assets that really aren't well recognized.
Mike, let's talk about some of the trends that we saw in this report. Once again, Spirit here pointing to what we've seen from some of the other competitors out there, the larger airlines, just about the fact that demand is still there, especially for domestic flights. What does that then, do you think, tell us about pricing and some of the trends that we could expect from within the industry?
Well, this is the real challenge you've got here. Your price has to depend upon what your costs are, and costs are going up for everything. The only advantage these super low fare carriers or super low cost carriers had was a lot of seats on the airplane and flying into markets where somebody would put off the kitchen overhaul and spend the money on a vacation. That's starting to go away. So I think it's going to be one of those things. Keep in mind, the traffic they carry is a very different well than the traffic carried by American or Delta or even Southwest on the whole. And the question is, how do they get into some of that traffic that America, Delta, Southwest, and United is carrying now? It's going to be very difficult to do, but that's what they're going to probably have to look after getting into.
Mike, just lastly, while we have you, we were speaking with the Hilton CEO, Chris Nassetta, yesterday, who was talking about the return of corporate travel and what they're seeing in trends there and how that also kind of carries through across both airlines and air travel and the accommodation space. With a proliferance of corporate travel making its way back, what does that mean for these ultra low-cost carriers where you typically see a lot of the corporate travel spending up for, more premium experience, if you will?
Well, it's also an issue of 2 flights a day to a destination. Like I have no idea, Knoxville to New Haven. That's not going to get business travelers on it. Frontier just made a move to try to get more business travel, but business travel depends on reliability. That's not normally an issue, but also frequency. And the other thing is, I'm sorry, but short haul business travel is dead. It's not coming back because I don't need to take the papers from Hartford to New York anymore. They already have them on a video call. So I think it's going to come back, business travel, but it's not going to be something that I think the current ULCC model is going to be able to really take a heavy advantage of, only because the model just doesn't accommodate business travel very well.
All right, Mike Boyd, always great to have you here. Again, Spirit Airlines shares up just about 4% on the heels of their results. Mike, thanks.
Thank you.
Keep right here on Yahoo Finance. Much more of your market action ahead. We'll be right back.
Shares of Maersk plummeting after announcing it's suspending its share buybacks. The shipping giant also highlighting high uncertainty over Red Sea disruptions in its 2024 earnings outlook. Take a look at shares. They are down 17% right now here. And, as we continue to track the kind of not full downfall, but the ultimate kind of action that continues to take place in the Red Sea, Maersk and some of the supply chain management companies, the most immediately impacted in the wake of this too.
Yeah, I mean, it just shows that the pressure that the industry as a whole is under right now, given that uncertainty, given the limited transparency that we do have just in terms of how long this issue could potentially stand. And this is something that Maersk pointed to in the report here this morning, saying that they have very little visibility as to whether this is a situation that's going to resolve in a matter of weeks or if it's a matter of months, or something that is going to be with them there and the rest of their competitors for the rest of the year. So given that, they've had to make these certain tough adjustments right now, suspending their share buyback program, giving that cautious outlook amid the disruption. You talk about the impact that this has had on freight rates right now. Exactly how long that is going to hold is another overhang here for the industry, limited visibility into that as well. So we're seeing that reflected in the stock price today, with shares under a tremendous amount of pressure. But again, lots of questions just about how long this issue is going to be a challenge here for Maersk and rivals.
Yeah, absolutely. Tracking shares here, again, still down 17%. You're right to call out that buyback program. And then additionally, that ocean results segment here within some of the Q4 highlights, that's where you could perhaps look and get that read through from the Red Sea part. The results turned negative in Q4 in line with the expectations that they mentioned, and just summarized that's a challenging market development as well.
All right, we'll keep right here on Yahoo Finance. Much more of your market action ahead. About 30 minutes into the trading day, you're still looking at the S&P just below the flat line. We'll be right back.
Welcome back, everyone. I'm Brad Smith alongside Shauna Smith. We're about 30 minutes into the trading day here on this Thursday. Let's take a look at how things are shaping up right now. The S&P 500 still hovering just under that 5,000 mark, that milestone that we're sitting on the ends of our ergonomic chairs for here. The index closed at an all-time high, though, on Wednesday. Investors will be keeping an eye on that level throughout. We're also, in tandem with this, watching Microsoft. That has struck a new all-time high, and we'll see how much we can hold on to that range here as the trading session goes on.
Yeah, Microsoft moving to the upside. One of the names that have really carried the market's momentum. All right, let's take a look at some of those other individual names. First up, you're taking a look at Harley Davidson. Now, ticker hog popping today. It's electric motor vehicle brand Livewire delivering a solid outlook for sales in 2024. You're looking at a gain of just over 4%. Now, Harley Davidson moving towards its goal of being an all-electric brand. And at least for now, it looks like it is registering here with consumers.
And a smoky outlook for the cigarette space. Ooh. We've got results from Philip Morris and British American Tobacco this morning here. Philip Morris missing expectations in its fourth quarter and offering a soft outlook for 2024. The company also saying that its electronic cigarette sales surpassed its top brand Marlboro. The British Tobacco Company, on the other side, seeing a little upside as it offers a better than expected forecast for growth in 2024. The company did report a pre-tax loss in its most recent quarter, driven by a previously reported write-down of its U.S. cigarette brands.
Johnson & Johnson spinoff Kenvue falling today after offering a soft full-year guidance on the company citing foreign exchange as a headwind for net sales growth. CFO saying that Kenvue is focused on consumer engagement and innovation in 2024. And you've seen that reflected a bit, some of that concern in the stock price with shares off just about 3%.
Well, PayPal missing the mark in its latest quarterly report despite a beat on the top and bottom line. Shares sliding the most since August of last year after the online payments platform forecasted flat growth in adjusted profits for 2024. Questions over the company's turnaround plan, they continue to be a concern for investors. For a deeper dive into PayPal's quarterly results, we're joined by Jason Kupferberg, who is the Bank of America senior payments analyst here. What is it, perhaps, that the street is sour on within this report from your perspective, Jason?
Well, thanks for having me this morning. I would say the number one issue that the street has with the earnings report is related to the 2024 forecast, not the Q4 results themselves. So for 2024, the most closely watched top-line metric for the company is transaction profit. Think of that as a gross margin type metric. And PayPal is expecting that its transaction profit dollars will not grow at all in 2024. So zero growth in 2024 after zero growth in 2023. There was some hope for reacceleration in that metric. And as part of that, the new management team indicated that the new strategic initiatives that were launched at the new CEO's late January event are not expected to move the needle on that gross margin or transaction profit metric this year. That's the single biggest issue impacting the stock today.
So, Jason, what do you think if it's not expected to move the needle this year? What do you think the upside then potentially looks like if maybe we have a longer timeline horizon, we're looking out to 2025 or 2026?
Agree. Yeah, we've been saying for the last few months, we think 2024 is a transition year for PayPal, and the new management team echoed that sentiment on their earnings call last night. It takes time to turn around a big battleship, if you will, and PayPal is certainly putting some more energy and execution effort behind some of these newer initiatives. However, it's a very competitive landscape, and they are, for example, trying to upgrade their core branded checkout experience, but it's hard to get consumers to change the way they pay. So that's one of the hurdles that PayPal, in a somewhat structural way, is up against. With that said, in theory, we would think that perhaps there'll be a little bit more traction the further out in time we look, once the company has a chance to pursue some of the rollout plans related to these newer initiatives.
Well, some of those initiatives include the subsidiary Venmo. We know that they've unveiled some new product innovations there, they called them, in late January here. What do you need to see in order to have a positive or more bullish outlook here on PayPal and some of the efforts within Venmo, including some of the transformations of checkout, fast lane, smart receipts, all of these things which for the consumer They're just trying to figure out, how much they can transfer back to their bank account without seeing that ding or the percentage that's taken out of it.
It's going to be complicated. It's going to take time. And what we would like to see ultimately is that the collective results of all the initiatives you just mentioned, do they start to move the needle on the most critical metrics that matter for the stock? So again, I come back to that transaction profit dollar growth metric. I would also cite branded payment volume. That's a critical metric too. They make a lot more money when someone clicks the PayPal button versus just paying directly, let's say, with their Visa card and PayPal just operating in the background as a processor. And so we do think that there is some value proposition for the consumer and for the merchant attached to some of these newer initiatives, but it's going to take time not only to roll them out in the marketplace and make them available, but to get the consumers and the merchants to actually adopt it and do some of the consumer education and the marketing behind it to actually drive uplift. And meanwhile, you're going up against Apple Pay, Google Pay, the ability that consumers have to just store their payment card credentials in their favorite browser. So those are the challenges.
Jason, talk about some potentially other challenges here. The New York Fed was out with a report earlier this week talking about the uptick that we have seen in credit card delinquencies and auto loan delinquencies. Not alarming yet, but when you see that trend to the upside, what type of risk does this potentially pose to a name like PayPal?
PayPal does have some credit risk. They do hold over $4 billion of loans on their balance sheet. Actually a little over $5 billion as of the end of December. About $4 billion of that is with consumers. The other $1 billion or so is with merchants. The company did talk briefly on their earnings call last night about actually getting a bit more disciplined with the issuance of credit, particularly to small to mid-sized businesses through PayPal's business loan product. So we do think that they are going to be careful in that regard because they are expecting some normalization of credit, i.e. some delinquency increases as we go through the year. So this topic is a little bit in the background for investors. Assuming the loan losses stay under control, it probably stays relatively in the background. We think PayPal also continues to have some opportunity to sell portions of that loan book over time. For example, they just sold a chunk of loans to KKR in their buy now, pay later business. So something to watch, but I would say secondary to some of the broader fundamental challenges that we talked about in core checkout.
All right, Jason Kupferberg, always great to have you. Thanks so much for joining us here this morning. Bank of America's senior payments analyst. Again, PayPal shares selling off here this morning. All right, we got much more of your market action ahead. Stay tuned. You're watching Yahoo Finance.
Really, you're only missing NVIDIA in terms of massive tech companies to report this week. And really, guys, I think the story here is understanding how big this is going to be for the overall market.
It's another year of overcoming a lot of challenges. As we think about 2024, it really is a year of execution for us. We've got the roadmap. We talked about 200 to 300,000 EVs being produced this year. We've got confidence of getting to variable profit positive in the second half of the year on our journey getting to mid-single-digit margins by 2025.
People are really focused on this move to generative AI, and that seems to be a very big focus longer term for the street, where Google has had basically a monopoly on search. With generative AI, you've got different players at least trying to dethrone them in some way.
Generative AI is 1 year old. We're 1 year into this new AI cycle. Microsoft, they disclosed their AI business actually doubled sequentially. It's now a $4.4 billion run rate business in year one.
We had a strong quarter in Q1, and it was really driven by our most loyal customers remaining engaged across the globe. And so as we think about going forward, as we look to some maybe more near-term and transitory headwinds, what we're really focused on is continuing to drive customers into our rewards program.
The fact that there's no guide here isn't really a suspension so far as I can tell, and I would attach that to not wanting to get ahead of the FAA. The FAA has asked for a freeze on the 737, arguably the most important product they do, and I think they're just being smart and not trying to get ahead of the regulator.
We're really happy and very proud about the results we delivered this morning. Being able to grow the company by 36% is historic in our context and in an industrial context in the pharmaceutical industry. growing 36% in an industry growing to the tune of 4% is also very, very special.
When people buy a new phone, they're buying a more expensive phone. And so we're seeing this tremendous mix shift towards more expensive devices, towards more expensive chips. And that shows up in our revenue growth.
The strong guidance for Q1 got it essentially above the street for revenues for Q1. And then the dividend, obviously investors are going to like that, showing continued expense discipline on their part. And so I think investors are really more focused by on the guidance and the dividend for Meta.
At $13.2 billion, which is what they did in the quarter, you have a trajectory that's, leading the company towards kind of a 10% bogey in 2025 now, which is not something that investors were expecting.
The number is a miss overall, but I think it's not a major disaster because it's all about the future here going forward, how they get the generative AI into their whole mix and all that. So there are a lot of other levers that they can pull, but at this point, it is definitely a disappointment that two areas that we were concerned about did disappoint.
Google announcing a premium paid subscription for its AI bot today, putting it in direct competition with its rival big tech powerhouse Microsoft. Breaking it all down, Dan Halley. They've been in direct competition for quite some time, but now they are going head to head on price.
Yeah, they're starting to smash against each other pretty hard right here. And so this is Google's Gemini. And so they previously announced the Gemini AI model. And that is basically the big smarts behind their ChatGPT competitor, which was Bard. Now they're rebranding everything. They're getting rid of the Bard name. That's going to be called Gemini. They had something called Duet in Workspaces. That now is gone as well. That's going to be Gemini. And they're launching this premium version of this bot. It's going to be $19.99 a month for regular consumers. They already have a version that's paid for the enterprise. But so this does put it in direct competition with Microsoft, in that Microsoft offers its Copilot Pro for $19.99 a month. Essentially what you're getting here is, the rebranded Gemini or Bard as Gemini. You also get 2 terabytes of storage, and then you also get Gemini inside of Workspace. So you're going to be able to get that in Gmail, in Docs, Slides, Sheets, all of that eventually. They're going to do that eventually. But right now, the big deal is that they're looking for a way to monetize all of their investments, and this seems to be a way that they're going to do so. Microsoft says they've seen a lot of interest from consumers, and so obviously Google feeling the same way, launching this now. And frankly, it seems like an interesting product. I'm not going to spend $20 on it, though. It's just not a thing that I want to spend $20 on a month. I got Netflix, baby.
I guess, real quick, sorry, what would be the adoption rate, do you think, just in terms of the fact that it is a little bit of a high price point? There are those that maybe if it was a bit lower, they would be willing to try it out. But being at $20, it might keep many people, and even you. You're a tech guy on the sidelines.
I'm also cheap, though. So, no, I think for most people, they're going to stick with the regular version of Gemini, which is free to use. You can download the Gemini app. You can, if you have an Android phone, you can make it basically take over for your Google Assistant. So you can hold down the side button, the former power button, and bring up Gemini and ask it questions. iOS, there's going to be an update for the Google app for iOS where you'll be able to just slide over to use Gemini. So you'll still be able to use a free version of it. The Gemini Pro version is going to use Google's most powerful Gemini model. So that's really where you're going to get all the, whiz bang pow of a kind of AI model that's at its peak. Whereas with, Gemini apps for free, you're going to get a slightly lower version of the model. Not saying that that's worse, it's just you're not going to get the same kind of capabilities.
All right, Dan, we'll see if anything tips the scale for you to try it out, but sounds like as
Make it free and then I'll use it.
Well, there you go.
I mean, we've high-end one free.
We've all become accustomed to free things from Google over our lifespans at this point in time.
Don't build me up like that, Google.
Exactly, Dan Howley, appreciate it. Well, switching gears, everyone, here. We're tracking shares of Under Armour here. They are climbing after better than expected earnings and a strong outlook overshadowing its steady decline in revenue. Weak sales across the U.S. and a slowdown in its wholesale business among the biggest challenges for the retailer. We've got David Swartz, who is the Morningstar equity analyst, here with us. David, great to see you. Just take us into what is at play more long-term for this outlook from Under Armour and where they're sitting right now within this mix of athletic apparel and footwear companies.
Right now, Under Armour is struggling for the most part. The company has no sales growth. Its sales were down more in the quarter from last year than I expected. And really, if you listen to the conference call, the company didn't really explain that anything's going to change in the near term. It's really going to take several quarters before we see a lot of new product and a lot of new strategies that are really going to drive any top line growth. Now, this is not entirely Under Armour's fault, of course, because right now the sportswear market is pretty challenged. In just the last few weeks, we've heard pretty dim outlooks from Puma, Adidas, and Nike. So right now it's kind of a tough market. And so Under Armour is trying to really drive growth in a period that's pretty tough for the industry.
So David, where does that leave Under Armour then from here? Because when you take a look at those inventory levels, yes, there was some improvement in the most recent quarter, but still not to the degree as maybe we were hoping to see some of that improvement. Obviously, going back to your previous point, Under Armour not alone in this, but in terms of what that inventory level looks like over the coming quarters, do you expect more material improvement there?
I think we will see improvement, but the problem is that wholesale orders right now are very low. The wholesale orders, especially in the U.S., are way below normal. And so it's very difficult to actually manage your inventory when stuff is not selling through and it's not being sold to your retail customers. One of Under Armour's biggest problems is that it's too dependent on the wholesale market. It's dependent on department stores like Kohl's. It's dependent on also sporting goods stores too. And so a lot of it depends on how healthy they are And right now, their orders and sales are not that strong. And so that's affecting Under Armour's ability to manage its inventory.
You know, David, we've been tracking some of the announcements from footwear, athletic footwear specific companies, and the innovation that some of them are trying to put forward this year and take to market, whether that's new entrants like Lululemon trying to finally get into men's footwear, and then you've got Nike with Air Max DN, which that comes ahead of Air Max Day. You've also got the chunky soles at Hoka on running. We could go down the list. What does innovation from Under Armour look like this year, and is that something that investors can hang their hat on?
I don't see a lot of innovation from Under Armour right now. And to be honest, it doesn't look like the company is really planning that much this year. A lot of the real product development cycle is really geared towards 2025, it seems like, at Under Armour. We've been warned about this. The company is going into more casual sportswear rather than its traditional performance sportswear. But it has explained to us that it's going to take some time for that to happen. The company has a designer, John Varvatos, who used to be a pretty well-known fashion designer on his own, who's now the lead designer for Under Armour. But we've been told that it's going to take some time for his products to actually reach the market, given the long lead times in this industry, which can be as easily 18 months from the time that a product is designed to the time that it actually reaches consumers. So I don't think we're going to see a lot of innovation really in the short term for Under Armour, and I think that's part of the reason why the stock is depressed.
David, do you think it's time for a brand reevaluation? I bring this up just because we're in the midst of a turnaround. You're saying it's going to take longer than maybe initially anticipated here to play out. Should Under Armour be further adjusting its business given the shift that we're seeing in consumer spending?
Under Armour really has been in a turnaround situation for about 7 or 8 years now. So there have been a lot of changes, and I think some of them have been positive. I don't think it's a situation where the company needs to panic in any way. Under Armour does have a strong cash flow this year. Its inventories are much better. Its balance sheet is very good. The company has minimal debt. So Under Armour really is not under any great pressure to turn things around right now. The stock price is clearly low here in the single digits, and that's a concern. But the company is not in any risk of distress. It's really just a matter of trying to generate top line growth again, which has been Under Armour's problem for years.
You know, David, one of the huge efforts that we've seen is leaning into the athletes. They've leaned into Steph Curry. They got the Curry brand there. They've leaned into The Rock. And for these different brands, I wonder, because we've seen Nike do this effectively as well, where they've been able to grow out Jordan brand for decades. Are any of these brands, kind of from the analyst perspective, tracking up against that similar growth that a sub-brand should also be taking on and being a net contributor to the overall performance for the company?
If Under Armour is really ever going to be competitive with Jordan and other top-tier brands, it needs to produce better footwear than we've seen traditionally from the company. Steph Curry is extremely popular. He's a great player, but he alone cannot drive Under Armour's footwear sales. The company still needs to put out shoes that people want to buy and that the collectors want. The company has talked a lot about its loyalty program. The CEO, Stephanie Linnartz, who came from Marriott, was involved heavily in Marriott's loyalty program. But the loyalty program does not help if you don't have the products that people want. And so it really does come down to innovation and style, as well as having relationships with popular athletes like Steph Curry.
Would love to know who your top pick in this space is right now, David.
Well, right now, I do think Under Armour is quite undervalued. My fair value estimate on it is $15.50. So I think it's trading at about half of what it really should be. It's trading at a low PE. Now, I recognize that the bottom line growth is not really there, but I do think it's actually at a buy at this level. There are other companies, too, that I think are quite undervalued. VF reported earlier this week. VF has serious problems. The company is doing a complete transformation, but I think the stock is way undervalued. And I think that people have just basically given up on any chance of it turning around. But VF has some significant brands, and some of them may be sold pretty soon, which I think will alleviate their debt problems. But, I think so VF and Under Armour would be two that I would highlight as being quite undervalued right now.
All right, David Schwartz, always great to get your insight there. Morningstar's equity analyst. Thanks so much.
Thank you.
All right, well, Disney shares extending gains after beating on earnings and also boosting its guidance. The company announcing a new partnership with Epic Games. While results seem to be impressing the street, activist investor Nelson Peltz is saying that there's much more work that needs to be done. Here's a look inside into Disney's boardroom battle.
Disney, the most iconic of brands, has faced an uncharacteristically rocky few years. It's been punctuated by a high-profile boardroom battle, but why did it all happen in the first place? The back and forth can be traced back to the controversial tenure of Bob Chapek, who first took over as CEO in late February 2020. What ensued is media history. The disruption caused by the COVID-19 pandemic, a controversial reorganization plan, a highly publicized battle over the release strategy of Marvel's Black Widow, and a damaging backlash over Florida's so-called Don't Say Gay law. To say this was the beginning of a tumultuous period for Disney would be an understatement. Fast forward to August 2022, and shareholder Third Point, a hedge fund run by billionaire investor Daniel Loeb, disclosed a stake of around $1 billion in the House of Mouse. It was something of a U-turn for the activist investor after having exited his position months earlier. Third Point wanted changes in the boardroom, for Disney to buy the rest of Hulu and for the company to spin off ESPN. Loeb got his change in the boardroom, and eventually Disney did commit to buying Comcast Hulu share, but that wasn't the big story of 2022. In November, a shock returned. Bob Iger was reinstated at the helm of the business he ran for years with great success. Top of the to-do list, get a handle on costs, and make the company's streaming business profitable. At the time, Disney shares were cratering, and had recently scraped 21-year lows. At the same time, reports swirled that another activist investor with deep pockets was circling the theme park giant. At the beginning of 2023, it all became official. Nelson Peltz, a billionaire activist and head of Trine Fund Management, wanted to join its board and make some serious and immediate changes. He wanted the focus back on creativity. Disney denied him a seat, saying he lacked the, quote, skills and experience needed, but changes would soon come. In February 2023, Disney, now firmly under Iger's leadership, announced major job cuts and over $5 billion in cost savings. Peltz laid down his sword, but he wasn't done for good. The activist reignited the battle in October 2023, saying Disney shares were undervalued. They were still trading below $100 a piece and had been for some time. His stake in the company had increased, up to around $3 billion worth of shares, and so had his vigor for battle. At the beginning of 2024, he made it official again. Peltz's Trine Fund Management formally nominated Peltz, as well as former Disney CFO Jay Rasulo, to the board. Their mission? A successful CEO succession plan and Netflix-like margins. But not all activists are taking on the Magic Kingdom. Hedge funds, Value Act Capital, and Blackwell's Capital have stood behind Iger. So where do we go from here? Expect the twists and turns to continue ahead of the company's shareholder meeting on April 3rd. Yahoo Finance will be there across it all.
Shares of Barbie maker Mattel are in focus on the Yahoo Finance platform for very good reason. Mattel reported that sales rose 16% from the prior year in the fourth quarter on strong demand for all things Barbie and Hot Wheels. But the overall report fell shy of what some on the street were whispering about. The company is forecasting flat sales this year, but more than 10% earnings growth, supported by a new $1 billion stock buyback plan. This as Mattel looks to fend off noted activist investor Barrington Capital. Joining me now is Mattel Chairman and CEO Anand Kreis. Anand, always nice to get some time with you. So really big quarter for you guys in Barbie, up sales up pretty significantly, as you would expect given the success of the Barbie movie. Can you unpack some of the drivers of that Barbie sales number? Because I think it would go a long way to informing investors on how the brand might do this year.
Yes, Brian, great to be here. And let me start by saying that it was a very strong fourth quarter for the company, with double-digit growth in top and bottom line and significant margin expansion. It was a milestone year for the company, not just the quarter. In addition to the incredible success of the Barbie movie, which we couldn't be more proud of, we extended our leadership in key toy categories and gained significant share overall and further strengthened our financial position. You talk about execution. We generated more than $700 million of free cash flow, which is more than 2.5 times the prior year. So with that, we continue to execute our strategy. As you mentioned, we just announced a $1 billion share buyback program and believe we're in an excellent position to continue to execute our strategy. And it wasn't just the Barbie movie. Of course, this highlighted much of the success, but there's so much more. The Barbie movie itself contributed about $150 million of top line and approximately $90 million of operating income. This is participation in box office and all of the movie-related merchandising and toys. So this is really an example for one movie in 1 year, and the potential is exciting for Mattel Films and overall for our entertainment strategy.
Now, JP Morgan caught my attention recently. They downgraded Mattel, and they mentioned there's a wall of worry with investors. Can you outperform what you did last year? Maybe speak to that point. Can you out Barbie? Can you show improving margins in your business this year after the blockbuster year you had last year?
Well, you've been following our story, and you know that we've been consistently executing quarter after quarter, year after year, and growing our IP-driven toy business and also executing on our entertainment strategy. And this is the approach we've been taking. You will see continued expansion and profit improvement, in the margin expansion of our toy business as we continue to accelerate the execution of our entertainment strategy. The portfolio has one of the strongest offering of children and family entertainment brands in the world. Our franchises are working, and we continue to execute on that approach. What we guided to in 2024 is to continue to improve profitability, gain market share, and expand our margin. And with that, we believe that we're very well positioned for 2025, where we expect to grow sales and earnings and continue to position the company for long-term growth.
No, you're exactly right. I've been covering your leadership at Mattel pretty much since day one, and the company longer than that. And you know, that experience really informed my next comment here. I didn't like that letter that Barrington Capital sent to you. Didn't like it at all. To me, it came off as someone or a group that didn't really understand the toy business, didn't appreciate what you've been doing over at Mattel. But I want to go through this tick by tick, because you guys came out last night, with a new $1 billion program. That team over there suggested you do $2 billion. Would going to $2 billion hurt your balance sheet? Like, why not go to that number?
Well, we always welcome feedback from our shareholders and are happy to have a conversation with our investors. We are focused on executing our strategy, and our goals are very much aligned with all of our shareholders to create long-term value. And without getting into the details of the letter, as a management team, we always look for ways to continue to create value and strengthen the company and position it for growth. The $1 billion share repurchase program that we announced is the right amount in our mind, that is in sync with our capital allocation priorities, with our balance sheet, and reflects our confidence in the continued execution of our strategy, and that we'll be able to continue to position the company for long-term value creation.
The letter also mentioned that this investor Barrington, who didn't reply to several requests from me to comment on this one, Fisher-Price and American Girl should be sold. Now, these are iconic toy brands. You walk into a toy store, these are brands parents know and they have known for many years. Do you think the performance of these brands is holding back the multiple that your stock can afford or receive?
We all been following we've been talking and been pretty transparent about both Fisher-Price and American Girl. As a management team, we always evaluate our portfolio, and we would like to have all of our brands grow and be in a strong position. We do have work to do on Fisher-Price, and we are doing it. We recently announced, a few weeks ago, we announced a leadership change and continue to put our mind and bring our incredible capabilities in design and development, in supply chain, in our global commercial organization that is second to none in our industry, to make sure that these brands are positioned for long-term growth. And again, without commenting specifically on a letter or any advice by our shareholders, that, as I said, we're always open to hearing. We are very focused on execution. We believe we have the right capabilities in the company. And as it relates to these brands, when you talk about Fisher-Price, and you said it yourself, it's a cherished brand. It's one of the most known brands in the industry. It had a strong quarter. It was up double digit. It continued to gain share. Little People performed exceptionally strong with expanded adult collector line. In 2024, Fisher-Price will expand its core product lines, enter a new segment, extend its licensed entertainment offering, and continue to exit lower margin segments in order to focus on profitability. So Fisher-Price is a valued asset, and we are confident in the long-term growth potential of the category as a whole.
All right, very important to hear that, Fum. And then I know, lastly, Anand, you have a really, I would say, a key investor day coming up in March, where you're going to outline some new plans and innovation for the year ahead. Anything you can share on what you might share at that event?
Yeah, we are looking to share more of the development and innovation of new product offering, how we think about the evolved playbook of Mattel in terms of brand design, development, the continued evolution of our entertainment strategy, not just in film, but in the other exciting verticals where we are looking to participate, such as television, consumer product and merchandise, location-based entertainment, digital, and other experiences that would truly capitalize on the incredible potential and value we have in our iconic brand portfolio. And it will be much about how do we, as a company, take brands that are timeless and make sure that they are timely, and continue to find cultural moments to engage with consumers, to engage with our fans, and position the company for exciting evolution on the IP strategy.
We always appreciate your transparency, Anand. That's why we have enjoyed following your leadership as Mattel Chairman and CEO. Anand Krize, look forward to catching up with you around Investor Day. We'll talk to you soon.
Thank you, Brian.
All right, do stick around. Much more ahead on Yahoo Finance.
Crude prices climbing higher this week. Now, this comes after Israel rejected a ceasefire agreement with Hamas. To break all of this down, the movement that we're seeing to the upside here in crude and Brent, Ines Ferre is over at the big board for us. Ines.
Yeah, Shauna, those Middle East tensions not ending anytime soon after Israel rejected that ceasefire proposal by Hamas. Also, the U.S. killing a militant commander in Baghdad. So you have a lot of tensions going on in the region. Of course, you have the Red Sea tensions as well with Houthi rebels that are targeting vessels in that area. So you have a lot of cargo companies that have been avoiding that Red Sea area. So today we're looking at WTI that's up more than 2%. Brent crude also higher, adding to yesterday's gains as well. And I do want to add that EIA data that came out recently that showed distillates, those saw a draw in inventories. That points to higher demand. Also, with the EIA forecasting that U.S. production will be slower than they had anticipated. So those record levels from December 2023, those aren't expected to be seen again until about February of 2025, with the EIA forecasting down their U.S. production forecast. And that is something significant because the street had been expecting that you would see a lot more U.S. production this year that would create a glut in supply, guys.
All right, XLE here on the day as well, up by about 0.7%. Inez, thanks so much for the update there. Appreciate it. Well, stocks are hovering near the flat line. The S&P 500 and the Dow coming off of record highs, but the S&P 500 still within spitting distance of that 5,000 level. But some on the street are debating whether the recent rally can hold, given just a handful of stocks are driving all of this upward momentum. We've got Christina Hooper live in living color in studio with us. She is the Invesco Chief Global Market Strategist, here to tell us more. Hey, Christina, great to see you, first and foremost. You know, as you think about this move higher and this momentum into some of these new all-time highs, how much longer can it last off of the back of just a few names?
So I think there's going to be some period of digestion soon. It makes sense. We've had a very strong rally, and it has been, as you point out, relatively narrow. But I do believe that what we're likely to see is something of a rotation, that we are going to see smaller caps perform better and cyclicals perform better as markets start to discount a reacceleration in the back half of the year. Certainly some of that will be generated by excitement around rate cuts coming soon. They don't have to happen in March, but hopefully sometime in the second quarter. I'm targeting May 1st, and that could be a bit of a catalyst as well for the smaller caps and cyclicals.
So, Christina, between now and May, though, I think a lot of that debate or a lot of the talk here centering around the fact that if we get any sort of disappointment, if we do start to see weakness in this handful of names, that could potentially trigger a wider market drop, potentially a correction, given the fact that so much of this momentum is just in a handful of gains. How should investors be thinking about that and protecting their portfolio from that risk?
So I think investors should expect some level of volatility. What we've seen is that expectations around the Fed and uncertainty and confusion there have created bond market volatility, which in turn have bled into stock market volatility. So I think investors should assume that we're going to see volatility, that we could see some sell-offs. I don't know if I'd say we're going to get to the point of a correction. So investors should be, I think, viewing this as the potential for opportunities. What we know is that many have an overweighting to cash on their portfolios. That's probably not a good idea if they have a long time horizon. So I would think of this more as an opportunity, but certainly investors should steel themselves and be prepared for some level of volatility. Don't get out of the market because you get spooked, because there's a sell-off. That, to me, I think was the single biggest mistake investors made during the global financial crisis.
What is that best portfolio positioning that you believe investors can enact or implement if we do see the timing of rate cuts continue to be pushed out?
Very diversified. So certainly adequate exposure to equities, adequate exposure to fixed income, and some alts. Within equities, be broadly diversified. It's going to happen. We just don't know exactly when, but the Fed will start cutting rates soon. And as a result, I think we're going to see a weaker US dollar. So having exposure outside the US makes sense, especially emerging markets where there's growth potential. Within fixed income, lock in those higher rates now. Go longer duration, have some investment grade credit in there, but also have things like emerging market debt. And then finally in alts, maybe scoop up some of those oversold opportunities like real estate, dare I say.
Hey, Christine, we're also getting some headlines out from Treasury Secretary Janet Yellen. She's talking about some of the stress that we're seeing play out within the regional banking sector right now, a lot of that being tied to New York Community Bancorp. But when it comes to the comments that she is saying, non-banks don't have access to backstop funding. She went on to say that concern in market stress could see a non-bank failure. And the reason why this is relevant is because of the role that they play in mortgages. How big of a risk do you see, or do you see the risk of a broader fallout here from what we are seeing stem out, at least right now, what seems to be relatively contained to at least one company?
So what I've seen thus far suggests to me this is very contained. Now, we can never control for market sentiment, right? It can run wild, even if it's not based on fundamentals. But based on what I see in terms of what's happening with New York Community Bank, it is very much one of only a few banks that share those kind of key factors where they had significant exposure to commercial real estate, low loan loss reserves. A lot of that had to do with the fact that they actually acquired part of Signature Bank. So they moved into a different tier and they had more onerous requirements that almost seemed to surprise them. So I think this is relatively isolated, but we do know that there can be a reverse halo effect that at least temporarily can affect other banks. And certainly we've seen the regional bank index suffer a bit as a result of guilt by association.
You know, one of the huge things that we've seen in terms of an overall theme that's been playing out as well. I know we were talking about broadening out this rally, but what if an investor out there says, you know what, AI and generative AI, perhaps this could be the next cloudification of companies' balance sheets, of companies' growth perspectives as well. How much more legs do you think that has to run as well?
Well, I almost analogize this. I'm so old that I lived through the late 90s and was in the business back then. So I remember the excitement around technology and in particular internet stocks. And the excitement was appropriate given all the potential that many saw. However, how it came to fruition over the 20 plus years since then, many did not predict. And so I would say there's an enormous amount of excitement around artificial intelligence, but recognizing that it may not play out exactly as people think. Certainly, I think it's going to add to productivity. There are going to be a significant number of winners, but we just don't know. I mean, there can be some zigs and zags along the way over time, but it does make sense to have exposure there. I would argue this is the kind of area where active management can really help.
Christina Hooper, always great to have you. Thanks so much for stopping by with us here in studio. Invesco Chief Global Market Strategist. Thanks, Christina. All right, we'll keep right here on Yahoo Finance. Much more of your market action ahead. We'll be right back.
An alleged cereal sabotage on aisle 7. Legendary rappers Snoop Dogg and Master P suing Walmart and Post Foods, accusing the largest U.S. retailer and the consumer packaged foods manufacturer for purposefully leaving their cereal off of store shelves. Last June, Master P joined Yahoo Finance to talk about the importance of becoming involved in the cereal space. Take a listen.
We're also the first black-owned cereal company. This has been going on for over 100 years that we've been consumers and never owners. So we're changing that game.
The latest here is that the two hip-hop moguls rejected a proposal by Post Foods to buy the cereal outright, according to the lawsuit filed on Tuesday. I gotta say that you will not find a better tagline in the entirety of corporate America than you will on this particular cereal box here, because at the end of the day, I think it's the creativity for bussin', yummy for the tummy, oh yeah, that ultimately I think is just showcasing some of the creativity that's needed in a very stale market here at the end of the day.
Yeah, it certainly is creativity that's needed. I was on set there when Master P did join us the last year. A lot of excitement around the debut of this brand. I think there's disappointment clearly on the side of Master P and Snoop Dogg, but also some of the other companies here involved. Walmart has not yet responded to this lawsuit, but when it comes to some of the disappointment that they have been seeing in sales, now a lot of this tied to the fact that it has not, at least they are alleging, it has not been put out on store shelves. At Walmart, it said that they went around, asked some employees about whether or not they had the cereal in stock, and when they looked it up within their system, it showed that it was out of stock when in fact they had it in the back room. So clearly there's a lot of clarifying that needs to be done within this accusation, but I think it points to the fact that this is an industry it's tough to break into, right? A lot of people have loyalty. You need a creative brand like that, but if you have that creative slogan and you have recognizable names, you would think an initiative like this, especially in a chain that has such customer loyalty like Walmart, it would do well. So I think there are a lot of question marks just about the sales on this product and why it hasn't done a bit better.
Yeah, this is a vastly different category than what we had seen Diddy and Diageo go through. Diddy alleging that they had neglected his vodka and tequila brands, but we'll see exactly what comes of this particular proceeding here for Master P and Snoop Dogg.
All right, well, let's do a quick check of the markets. Not too far from the flat line yet. The S&P still below that 5,000 critical mark milestone here. The Dow off about 63. The Nasdaq, though, holding on to gains up about 0.3%. Rochelle and Akiko have you for the next hour. We'll see you tomorrow.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo alongside Akiko Fujita. Here's what I'm watching this morning. Disney delivering an upbeat profit outlook for the year as it trims streaming losses in its latest quarterly results. This comes as the media giant doubles down on sports streaming. We'll look at its efforts to kick the streaming space into high gear.
Meanwhile, automakers going green are eyeing the move to hybrid. Ford CEO highlighting the increasingly important role hybrid will play in the industry's transition. We'll get a closer look at the role ahead for autos.
And Super Bowl 58 is just around the corner. As football fans gear up to watch the big game, companies are paying a hefty price tag for a 30-second ad spot. Is the payoff worth it? More on that later this hour.
First, though, let's do a quick check of where the markets are trading right now. 90 minutes into the trading day, the S&P 500. We are watching that one really closely, just right under that 5,000 level milestone. Trading down, but pretty flat right now. The Dow down 70 points and the Nasdaq up 52 points. Some big corporate stories we're watching today. Disney, we're going to get to that in just a bit. PayPal under pressure on the back of their results, but take a look at where ARM is trading. That stock surging ahead after reporting stronger than expected results. It's up 60%, nearly 60%, I should say. Let's also check in on the Treasury market. We got some data this morning. Weekless jobless claims coming in lower than expected at 218,000 there. And we are seeing yields move higher right now. The 10-year yield at 4.16% and the 30-year yield at 4.37. First, though, a strong quarter helping lift Disney's stock. The entertainment giant impressing the street with boosted guidance, cost cuts, and a new partnership with Epic Games. Those results, though, not enough to satisfy activist investor Nelson Peltz, a spokesperson at Peltz's firm Trian Fund Management, telling Yahoo Finance that, quote, "It's like deja vu all over again. We saw this movie last year, and we didn't like the ending." Despite that, Rochelle, we are seeing a big bump in Disney stock today, up more than 10%, at least so far in the session. Look, if you think about what Nelson Peltz specifically is seeking, there is a long list here. Part of that is about profitability for streaming, and you could argue Disney is moving in that direction. You think about the losses stemming in a significant way. We're talking about roughly $260 million in the quarter. It was $1 billion loss a year ago, so that marker has improved in a significant way. Disney reaffirming that the streaming business will be profitable this summer. So it'll be an interesting to see where the developments go here in this proxy fight, because Disney sort of throwing the gauntlet down yesterday with a long list of things that they are now announcing, but also showing improvements in their financials.
And I think you raise a good point about sort of where we are in the turnaround story versus where we were last year. This flurry of announcements that we got from Disney, including that partnership with Epic Games. You have the cost-cutting measures of $7.5 billion that Disney expects to meet or exceed by the end of fiscal 2024. You have the upbeat profit outlook, upping the dividend 50% from January. And of course, when you think of that $1.5 billion stake in Epic Games, and Bob Iger calling this Disney's biggest foray into the gaming space ever. And so the way at least Iger was framing it was that this activist push is more of a distraction. And it does make it more of an uphill battle to prove that, that Peltz is seeking these 2 board seats to justify it when you do have this sort of turnaround. But of course, it remains to be seen. As he said, seen this movie before. We'll have to see if it plays out differently, though, the rest of the year.
Yeah, all this leading to that annual meeting for Disney in April. It'll be interesting to see how those developments go through. By the way, Bob Iger sort of responding to what Nelson Peltz has been saying, specifically telling CNBC, the last thing we need right now is to be distracted in terms of our energy by an activist or activists that, in his words, frankly, have a completely different agenda and do not understand our company. We'll keep watching.
See. I'm sure that battle will continue. Yes, because Peltz says he's not giving up the fight, so we'll see what happens from here. Well, the word sports was mentioned in Disney's first quarter earnings call 50 times. As the company managed to trim its losses in its streaming division, it now looks to solidify its place in the sports world, announcing that its full suite of standalone ESPN channels will be available in the fall of 2025. And this comes after revealing a partnership with Warner Brothers Discovery and Fox for a sports streaming platform. Joining us now on this is John Kozner, Media President and former ESPN Executive Vice President of Digital and Print Media. Thank you for joining us this morning. So let's start by talking about the landscape that Disney is setting up here, because with this streaming deal, this will be the first time that you have your cord cutters and those who are loyal to cable will now have an alternative that really bridges both of them outside of the traditional cable bundle.
Yes, and the fans really want a bundle. I have a friend who's a big fan of the Arsenal Football Club who told me that he has to subscribe to 7 different services to see every game. So the movement, Disney announced 2 things yesterday. The movement to do the JV with Fox and Warner Brothers Discovery really addresses a consumer demand for better bundling. They also announced, Rochelle, as you said, that they're going to launch their flagship service, a standalone ESPN streaming service in fall of 2025. So these moves reflect sports fan demand. And it's just part of the evolution of the business away from the traditional pay television bundle.
John, how significant is the risk for cannibalization? I mean, the argument for very long has been that the only reason cable has gone this long or has been able to survive this long is because of sports. If you've got alternatives out there like the bundle, like ESPN streaming service that allow you to view that, what is the case for keeping cable around?
Well, there are lots of people who still want to get their channels in a traditional way, combining entertainment and news. The challenges for the new JV is going to be explaining to fans why they want this versus what they could get as a combination of channels. As we know, at least today, NBC is not part of this. CBS is not part of this. We don't know yet who's running the JV. We don't really have any details yet about the product around the JV. So there are a lot of questions there. And clearly, Lachlan Murdoch said this, they want to target those who are outside the system. So there is risk to cannibalization of existing pay TV subscribers, but the promise that this could be better and more focused for fans has the probability of bringing other people into the mix.
So as we look at some of the stakeholders involved there, because you talked about some of these key networks not being involved in this, and then you also have some of these sort of sports adjacent businesses as well, especially when you think of Netflix. How is that pie going to end up being divided, especially among consumers?
I suspect that all of the streaming companies are going to get into live sports. We saw Netflix make this 10-year agreement with WWE starting in January 2025. They have said that they don't see a model yet in terms of rental of expensive sports rights. But what has really changed for them, and same for Amazon and Apple, is they're all becoming bigger advertising players. And if you're going to be a big player in advertising, there's no better content than sports. So I fully expect Netflix to get into live sports. I expect Amazon to add more sports properties. And same goes for Apple. And that is probably one of the key factors driving the JV between Disney, Warner Brothers Discovery, and Fox, which is this competition from deep-pocketed competitors who have brands and meaning to consumers.
John, how do you think the sports leagues feel about this or think about this? I mean, it feels like there's increasingly a fragmented viewing experience when you compare it to how that has been or viewership has been traditionally.
Totally agree, Akiko. And reach, however one defines it, is the second key factor for sports leagues besides the revenue that they can generate in rights fees from these deals. So the prospect that the JV could put together an audience 12 months a year that delivers reach while the traditional pay TV bundle is shrinking, that's a concern. If you look at Amazon Prime Video, it has numbers now that rival pay television, and in the next several years may rival broadcast television. We saw 23 million people watch the NFL playoff game on Peacock. So the move towards streaming is picking up. But the challenge for a sports league that wants reach is, as you said, it's fragmented. So you're going to have to try to find it on broadcast television, pay television, and through streaming, and simultaneously. And we haven't really talked yet about the social media networks and whether or not they will play in any of this. They certainly will play in terms of short form content.
And John, to that point of really expanded audiences, when you think ahead, beyond the Super Bowl, you have the Olympics, you'll have the next World Cup as well, and you have most of the rest of the world viewing a lot of this content on their phones. How does that play into the dynamics and how some of these streaming companies are thinking about accessing those markets?
I just think, Rochelle, it gets to the creation of great sports fan experiences that reflect what device you're using or what your use case is. So the NFL Sunday Ticket deal with Google, YouTube, that included a bunch of development for creators on the YouTube platform, that's the example of something new. Fans are going to have an expectation that they can get what they want, when they want, on whatever screen they want. And you're also going to see breakthroughs in terms of latency, delivering low latency experiences on streaming, which today is a challenge. So the rights holders and the media companies and the tech companies have a tall order in front of them in that the expectation for improved experiences is growing among sports fans. And that's probably what's going to determine the winners and losers here.
Certainly a lot of shakedown likely to happen here moving forward. John Kozner, great to have you on today. Appreciate the insight.
Thanks for your time.
Time now to take a look at today's trending ticker. It's suddenly a sweet day for Hershey's as the stock reverses course, now up more than 5% after falling initially on news. Historically high cocoa prices will limit earnings growth this year. Rochelle, this is a fun one to talk about, right? Because we want to think about where the habits are. Cocoa prices, yes, a big part of that narrative coming through from the quarter. But I've been watching just the mix for Hershey. I mean, we talk so much about Hershey chocolate, sweet, confectionery. The company's been really trying to expand further into salty snacks. So we're talking about Skinny Pop, Pirate's Booty, Dots Pretzels, but there was a significant drop there. Sales fell 24.6% compared to where it was a year ago. Some of that inventory management issue as well, but I don't know. I'm curious about what that demand looks like moving forward. Sweet or salty?
I mean, I'm always going to be team sweet. I mean, I've born and raised on chocolate. Full confession, I used to eat about 5 chocolate bars a day, like obsessed. It was a problem. So I'm always very invested in what happens with cocoa prices.
I think we're in the same camp, Rochelle. We'll have to have another discussion about snacking there.
Balance is always good, but yeah, it's interesting to see because we've sort of seen some of the writing on the wall for cocoa prices continuing because we saw some of the issues with drought and some of the biggest cocoa producers in the world. So now seeing that the cocoa price is continuing to hit historic highs, but as you mentioned, if you have demand for these products, you have to wonder whether or not people will still be willing to pay these prices as they go up. For me, I'm in too deep. I'm going to keep spending my money on chocolate. What about you?
Yeah, I don't think chocolate is an area where I would ever cut back, but that's just me. That's just us. We will continue to contribute in that way.
It's true. Sweet for us, and also Hershey raising its quarterly dividend by 15%. Something sweet for investors as well. All right, well, coming up, the S&P 500 is nearing that 5,000 mark for the first time ever. We'll break down the recent market rally after the break.
The S&P 500 is on the brink of reaching the 5,000 mark for the first time. Robust economic data and upbeat earnings have lifted spirits on Wall Street, despite uncertainty about the timing of the Fed's rate cuts. So how should investors be looking at their portfolios? Here to discuss, let's bring in Burns McKinney, NFJ Investment Group Managing Director, Senior Portfolio Manager, to this conversation. It's good to talk to you this morning. Let's start by talking about earnings, because that does seem to be the big driver, at least today, when you think about the big names like Disney really surging ahead. More than 80% of S&P 500 companies that have reported earnings reporting beats. What have we seen in terms of the outlook that suggests that momentum can continue?
One of the things that's been interesting about this earnings season has been that stocks have reacted somewhat favorably on both the upside as well as less unfavorably on the downside than one might have expected, particularly given how rich the market is. Typically, when markets are, kind of reaching a high level, and in which too much optimism is baked in, then you would expect to see stocks react a bit more negatively to negative earnings. We haven't seen that so much this period. That said, I think that's probably, if anything, the dynamic that's continuing. It's that the market isn't necessarily responding as much to the fundamentals or earnings as it typically is. I think if you just you look on a day-to-day basis, we're continuing to see the same dynamic that we had in 2023. And that's that on a daily, weekly, monthly basis, the key driver for equity markets overall has been what interest rates have done. When you had in the fourth quarter, the Fed pivoted and suggested that, okay, we will be perhaps lowering rates next year. That's what led to that everything rally that really, for all intents and purposes, I think one of the ways we've kind of put it is that the market had a great 2024 during the fourth quarter of 23. And to some degree, I think a lot of that dynamic is overwhelming the individual company by company earnings impact.
So then, Burns, what do you think is going to define the current state that we're in? We have markets sort of essentially in a holding pattern, waiting for these rate cuts. The Fed also in its holding pattern as well. What are the picks then that you would advise?
Well, if we look at the market overall, you can't argue that stocks are cheap. I mean, right now the S&P 500 is trading at 22 times earnings. It's more expensive than it's been, 3/4 of the time over the last 25 years. That said, the old dictum is it's not a stock market; it's a market of stocks. And so, there definitely are opportunities for investors. And the other dynamic that we've seen really ever since the Fed pivot is that seems to have kicked off a situation whereby you've increased the breadth of the market. And after you saw that Magnificent Seven really lead equities for all of 2023, you're starting to see a bit of a broadening, whereby a lot of the areas that were laggards last year have started to maybe make a little bit of a breakout moves. Areas that didn't do as well last year, things like real estate, things like utilities, even some of the banks. And so, what we're advising investors is to build a portfolio of quality names. And likewise, because inflation sometimes does have a second wave, and in case it does make a comeback, one of the best ways to combat that is companies that are both paying and raising dividends is a great place to be in this type of market.
So Burns, let's talk strategy, specifically on the sectors that you're liking right now, industrials and healthcare. What do you see there, and what are the big names that you think investors should be watching?
Well, in the case of industrials, you have some longer term secular trends. For one, we're really seeing in the U.S. a rebuilding of our industrial base. That spending has lagged for many years, and with onshoring, I think that's another driver of that. And probably one of the biggest drivers would be the infrastructure bills that were passed. I understand that was really more in the news 2 or 3 years ago, but a lot of those dollars are just starting to go out the door now and aren't expected to peak until 2026. And so investors have that in their favor, and a circumstance where valuations aren't terribly demanding. And on the flip side, healthcare, especially in a market when we really are saddled with uncertainty, healthcare is the one sector that kind of allows investors to kind of put one foot in one area and 1 foot in another. Specifically, it's an area that investors can play defense, given that stocks are somewhat rich. You do have positive long-term demographics, but you can also play offense. That's the sector for which, going back over the last several decades, where you've seen the best earnings growth, even faster than the growth you've seen in tech. And so, you really get kind of the best of all worlds with the healthcare sector.
And Burns, I want to ask you about the potential for how you weigh a wage price spiral, because one of the things that came up in Treasury Secretary Yellen's testimony was you're seeing wages continue to go up, but you're also seeing inflation sort of holding steady, but the core indicator at that 2% rate that the Fed is looking at. So what do you do with that in terms of how you're planning to navigate this if this does continue for a prolonged period of time, this higher for longer?
When you think of wage price cycles, one of the most important dynamics that investors should look at is investor expectations and market expectations. And one of the things that does have us feel a little bit more sanguine, or maybe a slightly less concerned with that, is the fact that investor expectation, because you can result in that self-generating cycle, but throughout the inflation wave that we've seen over the last couple of years, investor expectations have remained somewhat in check. And in fact, over the last several months, those have in fact pulled down a little bit. And so, that's one thing that helps. The other factor being, I think that maybe pushes the other direction would be that, the jobs market is still tight. The Fed is, it seems to have threaded the needle between not necessarily cutting jobs, but job openings, which might actually give a little bit of cushion. But nonetheless, when the Fed started their tightening cycle, unemployment was 3.6%. Today it's 3.7%. With even though there's a lag, that's kind of accounted for. And so the job market remains strong. I think that's one reason why the Fed is really concerned about repeating some of the mistakes that central bankers made in the 1970s. And that's probably, if anything, that investors can take from what I'm saying there is that they're probably going to err on the side of not cutting rates too soon, and just really not take any chances of losing any long-earned credibility.
Indeed, that fear of reacceleration of inflation still heavy on the Fed there, indeed. Appreciate you taking the time to join us this morning. Burns McKinney, NFJ Investment Group Managing Director, Senior Portfolio Manager. Thank you so much. Well, on Friday, EU officials moved closer to adopting the EU's Artificial Intelligence Act. It's the world's first attempt at comprehensive AI rules. And like the EU tech laws that came before it, the act is expected to impact companies beyond EU borders. Let's get to Yahoo Finance's Alexis Keenan, who's been looking into the EU's growing influence here. Hey, Alexis.
Hi, Rochelle. Yes, so big news on Friday with the EU's ambassadors unanimously approving this new AI law. It's supposed to be this attempt at comprehensively regulating AI and the technologies to come, expected to be in force, in effect, in part, some of its provisions, as early as May or June this year. Now, this approval, though, what it does is it really adds to the EU's global sway in how companies operate, especially in the tech space, and how they use, how they create, and how they distribute their technology. And that's because the companies that do business, either within the EU or with EU consumers, they're going to have to ask whether they should tailor their products and services to meet the expectations and requirements of these laws, or whether they're going to go market by market and customize their products and services. But at the same time, this level of influence, it's not really new. In 2012, it was coined the Brussels effect by a Columbia University law professor. And that was really to describe the EU as this kind of de facto exporter of its laws and regulations. Because you have to remember, before this EU Act, you had GDPR in 2012, I believe it was. 2018, pardon me. That's governing data privacy. Then came the Digital Markets Act and the Digital Services Act, still now going into effect, with the Digital Services Act just taking effect and having to be complied with in 2024, January this year. And then, of course, you had the European Commission and its aggressive with pushes against major mergers. You go all the way back to 2001. You had GE and Honeywell's would-be merger derailed, $42 billion one there. You had Amazon and iRobot just this year, $1.4 billion deal. You add to that Adobe and Figma at the tail end of last year, $20 billion deal, and also Illumina Grail. This push all coming from the EU, that breaking up these big deals. But the concern, guys, is that the small and medium-sized companies will have trouble complying with these laws. It's not the big tech companies that will have to contend so much with trying to get it straight. These laws are incredibly, incredibly detailed, and it is difficult to comply.
Indeed, especially for these multinational companies trying to balance everything at both ends, but at least something of a framework potentially for the US to follow. Appreciate you breaking all of this down for us.
Potentially. You bet.
Yes. All right, coming up, are hybrids the next best bet, or will interest wane? We'll speak with an expert on the other side of this break. US car buyers are increasingly looking to hybrids as sales of electric vehicles pull back. Hybrids now make up more than 9% of new light vehicle registrations. That's according to the S&P Global Mobility Report. Now, Ford CEO Jim Farley is saying that hybrids will play an increasingly important role in the transition for consumers to go fully electric. On the other hand, Toyota CEO is predicting that pure EVs will peak at 30%, leaving a large space for hybrid cars. Let's bring in our next guest, Michael Dunn, Dunn Insights CEO, to discuss more. Thank you for joining us, Michael. So what do you think is going to be the key three factors that will drive hybrid conversion and adoption?
What we're seeing right now is the end of the honeymoon for pure electric vehicles. You know, for the last couple of years, there's been sensational interest in buying electrics like Teslas or your Mach-E's from Ford or your Hyundai Ioniq 5. But what's happened is that consumers have realized, hey, the charging infrastructure is not great on these things. They're expensive, and maybe there's a better alternative. So we're moving into more of a realistic, practical consumer. The first movers, the leaders who would go for those electrics are now moving to mass market. And those consumers are saying, give me something much more practical that I don't have to worry about range or charging. And their solution is to move, exactly as you said, into hybrids. We're seeing a surge in demand for hybrids while demand for pure electric vehicles is slowing.
Michael, it feels weird to talk about hybrids having a moment because they have been around for a while. And you look at a company like Toyota, who for years have said this very issue, that EVs are going to be slow in terms of adoption. Hybrids will be a longer bridge than you expect. How long does that transition look like for you? I mean, does it make sense for a company like GM, for example, to suddenly pivot to hybrids when you consider where the overall EV transition is going?
Absolutely. It's a longer run than most people expected. So we're talking about a 10-year transition before electrics, in Toyota's case, as you said, just 30% of the market. Others are more optimistic. But what's happening around the world is that people are realizing range anxiety is real. Charging infrastructure is not that great, especially here in North America. Prices of electrics remain high. So why don't I just buy a hybrid or a plug-in hybrid? I get something more affordable. I don't have to stress about range, and I can get in. There's a lot of options out there from Toyota, from Ford, from even Chinese companies like BYD. There's definitely competition now in the minds of consumers. Hey, I don't necessarily have to jump to pure electric. I can do very well with a hybrid.
Michael, is this a U.S. specific story? Are you seeing the sales of EVs stall out in places like Europe, for example, or especially in China, where the infrastructure is much better and the access to those chargers are better?
Highly uneven. You're exactly right. The picture is highly uneven. In China, 1/3 of new car sales are electrics, in large part because the infrastructure in China is second to none. It's superb. Now, in Europe, what we've seen is as incentives in places like Germany have gone away, demand for electrics have more or less collapsed. So it is a geographical story. And here in the United States, because we love our big vehicles that are heavy, we love to travel at high speeds on the highways, those are behaviors that are much better suited to gasoline or hybrids than to electrics. A pure electric battery does not like to power a heavy vehicle at high speeds on mountains in cold weather. It's just not suited for that. So in a way, there's some American exceptionalism going on here where hybrids and plug-in hybrids make a lot more sense in many cases than pure electrics.
And Michael, as you're mentioning the different categories of hybrids, because not everyone is familiar with them. You have the mild plug-in, your traditional plug-in as well. What do people need to know about the demand for those and also the pricing? Because usually when you think about a car, it's the repairs, it's the insurance and being able to resell it.
Right now, pure battery electric vehicles are the most expensive as a group on the market, right around $50,000 on average. When you step into plug-in hybrids or hybrid vehicles, gosh, those can start with a Prius in the high 20s, and you're getting tremendous gas mileage. So there is a gap. Think in simple terms, pure battery electrics are fantastic, fun vehicles like your Teslas, but they're expensive and you need charging. The plug-in hybrids and the hybrids, your range anxiety goes away because you have the engine to power the cars.
Michael, let's talk about battery electric EVs, because I mean, at the end of the day, that transition is happening, even if the pace of the transition is slowing. So much of the battle between the US players, particularly, and the Chinese players have been happening in China, the world's largest EV market. Something caught my eye earlier this year when you put out a prediction that suggested that fight is going to shift over to North America. Talk to me about what you're seeing there and How long until a company like BYD, for example, you think actually gains access into the US at a much cheaper price point?
You're exactly right. What we're seeing inside China is that as the economy slows, they have massive overcapacity, up to 10 million units of overcapacity. So all automakers in China are now setting their sights on global markets, pushing out to anywhere they can sell their cars outside of China. Last year, China surpassed Japan as the #1 exporter of vehicles globally, and they're just getting started. Companies like BYD and others definitely have their sights set on Europe, where they're already moving in, and on the United States. Now, here in the US, there's this thing called a 27.5% import duty that has really stalled the Chinese advance when it comes to the American market. But there's no question that Chinese automakers need access to Europe, the United States, and other global markets, drowning in overcapacity with price wars and no margins. So it's really the trend for the next 5 years that competition will move outside of China into global markets, and it's happening now as we speak.
Interesting to see that shift playing out. Michael Dunn, Dunn Insights CEO. Good to talk to you today. Appreciate the time.
Thank you.
Well, the rise of office to apartment conversions has grown over 350% in just 3 years, according to data from Rent Cafe, largely due to lifestyle changes made during the pandemic. Let's bring in Yahoo Finance's Danny Romero to break it down. Danny, the argument for so long has been that for these buildings, it doesn't make sense from a cost perspective to convert from offices to apartments. Is that calculation starting to shift a bit?
Completely. I mean, we're seeing it in the numbers, and I will have to highlight that it's been a slow process, but the big push to convert office buildings to residential housing is working. There are more than 55 office buildings to residential conversions that are in the pipeline across the country. The biggest chunk is actually coming from Washington, D.C., with more than 58 housing conversions. Then is New York with more than 52 housing conversions, then Dallas, Chicago, Los Angeles to follow. So this is positive news on the housing front. But the total amount of housing conversions really is a drop in the bucket compared to the rest of the market. So if we look at, for example, 25 Water Street, it's a 22-story building in the financial district in Manhattan. That will be converted to more than 1,200 housing units. But that one building represents 24% of New York City's conversion pipeline, which really further highlights the slow process to roll all of this out. Other data from New York City also shows that 46 buildings are part of this conversion program, and only 4 have gotten started so far. So definitely it's been a slow process. Akiko?
So, Danny, I have to ask then, why aren't there more conversions so that you don't have this empty space sitting here while you have these very expensive leases?
The simple answer is that commercial buildings are not really designed with the intent for residential living. A lot of these buildings will need major structural changes, and that will be a hefty price tag for investors, developers. Another factor to the equation to really think about when we're thinking about this in further terms is that a lot of multifamily supply will be hitting the market this year. So whether or not that will impact these programs, these plans to convert office buildings to residential housing, we'll have to wait and see if there is any impact there. But it's also really important to note that the federal government has provided $46 billion in stimulus for housing conversion. So there really is a lot of incentive now to do all of these changes.
Indeed. We'll continue to track that. Appreciate you, as always, our very own Danny Romero. All right, stay with us on Yahoo Finance. All your markets action still ahead. Stay tuned.
Companies are investing big in advertising ahead of the big game this Sunday. The average cost for a 30-second Super Bowl commercial is reaching $7 million for the second consecutive year. And brands are looking to get their money's worth, with Forbes forecasting viewership will exceed the record 115 million. For more on this, we are joined by Tal Jacobson from Perion CEO. Tal, it's good to talk to you. $7 million is a lot of money. How significant is that return still? Is this the broadest audience that brands can reach?
I think it's absolutely, amazing that it went up to $7 million. But look at the Sphere at Vegas. It now went up to $1 million for a spot. $1 million for a spot on the Sphere. I think, obviously Taylor Swift did an amazing job getting a lot of new audience to see the Super Bowl, more females, more Gen Z, more millennials. But absolutely, I think this pushes a lot of advertising budgets. We at Perion constantly looking at how do we get those promotions across all channels. That's what we actually focus on with our technology. And specifically with the Super Bowl, companies, Elf Cosmetics, NYX, which cosmetics we would never think about advertising with in the Super Bowl. 20 years ago, it was mainly Budweiser, right? But they're shifting into that, and they're constantly thinking about the bigger picture. So they're going to do, TV ads, CTVs. They're going to do out of home, like the Sphere or other programmatic out of home, but also a lot of social. And this is where actually our company gets into play. How do we connect all those channels? How do we actually make sense out of all those channels so the advertiser actually makes sense?
So Tal, how are advertisers planning on dividing up the pie of where they're spending this money, given the range of ways that they're trying to reach viewers?
So, it all starts with demographic, right? The fact that Super Bowl is now 46% females, that's a big shift. So that's why you're going to see a lot more ads for cosmetics, a lot more ads for lifestyle. But again, social is booming. CTV, which is TV ads for streaming, is booming now. Everybody's going to look for that. On a $7 million for an ad, that's for linear, but it also happens on CTV, so on streaming. But with streaming, you can actually customize the message through the location. So with linear TV, you would normally get the same message nationwide. With CTV, you can actually customize that based on location. So people in different locations are going to get different messages.
Yeah, that's interesting to hear more targeted ads available on that front. Tal, we've been talking a lot about what the digital ad space landscape is right now on the back of these earnings results we've gotten from companies like Meta, Alphabet, Snap, Pinterest after the bell today. As you consult with brands, how do you advise where they should take their money? At the end of the day, is it a name like Meta because you've got such scale across their platforms? And on the flip side, given where Snap moved yesterday, what is the case to take your ad to Snap when you've got so many other platforms to go to?
Right. I think that's an excellent question. So with Snap, they have a younger audience than with Meta, right? So, Snap, also TikTok have younger audience. I think the issue with those type of platforms, they're, as you have global tensions, wars and stuff like that, you're also turning those social platforms into kind of a news portal. So companies, big brands don't want to be associated with those type of, that type of content. So it depends on the audience, depends on the level of the brand. You want to make sure that you have brand safety filters, right? You want to make sure you have the right audience, and you always want to diversify the spending. You always want to have more than one channel, and to be able to measure all those channels to make sure that you're getting the right ROI that you're looking for.
Tal Jacobson, Perion CEO, it's good to talk to you today. Certainly timely conversation given Sunday's game. Thanks so much.
Thank you.
All your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Well, how much do you have saved for retirement? Well, don't panic. Nearly 25% of Americans can't answer that question either, according to a new report from TIAA. To break down why this is so detrimental for people's golden years, Yahoo Finance reporter Kerry Hannon is here. And Kerry, I know people don't like to think about money, but when they think about retirement and the kind of life that they expect to have this larger proportion of people not even have a plan, very concerning.
Yeah, I mean, it's pretty shocking to me, Rochelle. I mean, the thing is, this is kind of, are they just not paying attention? I mean, what's going on here? And I think that, it's really important because this is the number one step to being prepared to retire is just knowing how much you have right now to work with. And so, why do people need to know this? You need to know this because it gives you an idea of how much longer you're going to have to work, perhaps. What kind of income you're going to have in retirement? Will you need to continue to work after you retire from your primary job for more income? And how much should you be saving right now? And what kinds of investments should you be investing in? These are important decisions to make. And if you don't know what you have in the kitty, this isn't going to be a very easy choice for you. The second thing is, why don't people know? Okay, so I just was kind of chuckling away about they're not paying attention, but the fact is, I think what happens is people, it seems far off, and they get very distracted with day-to-day living things. And maybe they think that they're saving enough in their employer plan and the employer match, so that's good enough, that they're going to be okay. And a big one is the people I know, Rochelle, actually do look at the retirement accounts, but they don't retain the number because it doesn't mean anything. It doesn't say when they're going to retire or how much income they're going to have in retirement. It's kind of hard to get a grip on it. And so I think what happens, a big part of why people don't know also is that we change jobs a lot. So if you're like me, I've got retirement accounts at 3 different financial services companies. So it can be a little hard to keep track of everything. So it's to know the precise number can be a little difficult. So here's the thing. Here's what people can do. I think, you really need to think about what percentage of your income you're putting away each year, and it should be roughly 50% of your income if you can get there.
Carrie, it looks like we're having some issues with your connection there, but you can read all about this online at yahoofinance.com. And Carrie, we're going to have a conversation after, I think. Let's talk about my retirement plans. Carrie Hannon, as always, our thanks to you. Let's do a final check of the markets here before we let you go. We are looking at a bit of a split picture. The Dow down 106 points. The S&P 500 down about 3.7 here in the Nasdaq, up 41. Of course, we are tracking the S&P 500 to see if it can hit that 5,000 level, which would be a significant milestone there. That does it for Rochelle and I in the 11 a.m. Eastern hour. Much more to come here on Yahoo Finance Live. Keep it right here.